What if I told you that in just a few short years, the internet made and unmade more fortunes than any single event in modern financial history? What if the greatest boom of the 1990s ended not in triumph, but in collapse? And yet, some of its survivors built the foundations of today's tech giants. You probably know some of the story, that there was a dot-com bubble, that it burst, and that many lost everything. But the real forces behind the boom and the crash are far more subtle, more mechanical, more human than you think. And the echoes of that era are ringing today louder than ever. In this video, we'll unravel that hidden architecture, how money, hype, hubris, and narrative collided to create one of history's most spectacular financial catastrophes, and how the same forces whisper in today's markets. Stay with me. The twist might be in how the crash was necessary and how it seeded the next generation. To understand the dot-com bubble, we must step back and grasp what was being sold. Not just companies, but a vision. In the early to mid-1990s, the World Wide Web moved from academic curiosity to public phenomenon. Mosaic, Netscape, and early browsers made the web accessible to non-technologists. Suddenly, people believed the internet would rewrite every business model. Retail, media, communications, everything would shift online. But here's the paradox. Most of those early companies had no revenue, no profits, even no fully proven business models. What they had was promise and hype. At the same time, the financial environment was fertile. Interest rates were relatively low, and capital was readily available. Venture capital firms were hungry for the next big thing, regulatory changes, like the Taxpayer Relief Act of 1997 in the US, which lowered capital gains taxes, encouraged more speculative investment. And the dot-com narrative found powerful champions, media, analysts, and even policymakers who saw in the internet the promise of the new economy. One name looms large: Alan Greenspan. His speeches about irrational exuberance aside, the Fed's posture, keeping liquidity flowing, gave fuel to the speculative fire. So here's the twist we'll hold until later. The bubble's collapse was not simply an accident. It was baked into the system. The same forces that drove explosive growth also contained within them the seeds of collapse. And, ironically, the collapse cleared the field for the next generation of sustainable tech giants. But that's a story for later. First, how did we go from promise to mania? In the early 1990s, the internet was still niche. Only a fraction of US households had computers. Only a fraction of computers were online. Between 1990 and 1997, household computer ownership in the US rose from 15% to 35%. That shift set the stage. Computing was moving from luxury to necessity. The rise of browsers like Mosaic and Netscape made the web usable and exciting. Entrepreneurs began launching dot-com companies, online bookstores, portals, content sites. Venture capital followed. Analysts touted the internet as a paradigm shift. In a way it was, but many investors conflated promise with immediate profitability. In 1995, the Nasdaq Composite Index hovered around 700 or 800 points. By 1997, it had started climbing sharply, but crucially, most of these companies were spending aggressively to gain eyeballs, marketing, infrastructure, customer acquisition, without a clear path to break even. They gambled on future scale overcoming early losses. By 1998, things went hyper. The Nasdaq and tech indices began to detach from fundamentals. Investors were less interested in profits. They chased growth, novelty, momentum. Consider these dynamics: IPO frenzy. Companies with little or no revenue were going public and commanding sky-high valuations. Get big fast strategies? The belief was that dominance, market share, would eventually convert into profits. Blind faith in network effects. Many believed that first-mover advantage could entrench new firms. Media amplification. Stories of overnight wealth abounded. The press rarely asked, "But how will you make money?" Follow the crowd psychology. Institutional and retail investors were both caught up in FOMO, fear of missing out. Between January 1995 and the bubble's peak in March 2000, the Nasdaq rose by roughly 582%, from 751 to 532. By contrast, after March 2000, the Nasdaq would fall by 1,075% by October 2002. To many investors at the time, this seemed unstoppable. Profit metrics felt old-fashioned next to endless potential. But, as in any bubble, cracks began to show. Money from the faucet slows by late 1999 and early 2000 capital, especially speculative capital, started becoming more constrained. The venture pipeline dried. Companies that had assumed perpetual funding found themselves suddenly under pressure. Earnings misses and revealed weakness. When companies finally reported results, many couldn't deliver. Cash burn was enormous. Revenue growth was shallow in many cases. Many of the assumptions about converting scale into profit proved harder than promised. Investors began to ask, when does real cash flow arrive? Multiple compression valuation multiples began to contract. High-growth speculation now had to fight harder to justify sky-high valuations. Catalyst events and panic, then came the triggers. A few high-profile failures or warnings acted like detonators in a minefield. Sell orders cascaded. Margin calls, tightened March 10, 2000, became a symbolic peak. The Nasdaq Composite hit 5,048 at 62 before reversing sharply downward. From that peak, the crash accelerated. Between 2000 and 2002, trillions of dollars of market value evaporated, and hundreds of internet companies failed. No bubble burst cleanly. The aftermath of the dot-com crash was brutal and widespread. Massive bankruptcies, names like Pets.com, Webvan, Boo.com, and eToys became symbols of excess and folly. Many had raised large sums, but burnt through cash quickly. Telecom and communications firms like WorldCom, Northpoint, and Global Crossing also collapsed or restructured. Wealth destruction investors, retail and institutional, saw massive losses. Many smaller investors lost life savings. Venture capital firms took huge write-offs. The Nasdaq lost most 75% of its peak value by late 2002. Economic drag and recession. The shock contributed to a mild U.S. recession in 2001. Tech budgets were slashed. Layoffs and hiring freezes were widespread, especially in Silicon Valley. Survivors, consolidation, and reset, but not every company died. Amazon, eBay, Cisco, and Bertelsmann-backed firms that had more durable business models survived. Some even thrived. In fact, the crash cleared weaker players and refocused industry attention on sustainability. Looking backwards, irony many. Of the nascent ideas that were overhyped in 1999-2000 would come back stronger, but in more disciplined form. The crash, in effect, catalyzed a more mature phase for the internet. Attempts at repair and missed fixes in the wake of collapse. Regulators, market participants, and firms attempted to restore confidence and prevent recurrence. But not all fixes succeeded. Regulatory scrutiny and reforms. After the crash, policy and regulatory interventions followed. Analyst conflicts of interest were exposed. The global settlement in 2003 forced major Wall Street banks to pay fines and separate research from investment banking. Reforms to accounting. Rules and disclosure requirements increased. Transparency, market restructuring and valuation. Disciplined investors became more skeptical. Metrics such as cash flow, EBITDA, and price to earnings regained importance. Story stocks lost glamour. Many venture capitalists became more cautious and selective. Technological infrastructure built in the lull ironically during the bust. Infrastructure, fiber, data centers, broadband, expanded, laying the groundwork for the future. Many companies built quietly and steadily, preparing for the next wave, limits and failures. Despite reforms, the root human and structural dynamics, hype, narrative, capital cycles were not eliminated. Bubbles did not vanish. In practice, the market remained vulnerable to new mania cycles down the road. The dot-com bubble may seem like history, but many patterns are repeating today, and with higher stakes. The AI and tech boom and bubble comparisons analysts and researchers increasingly draw parallels between the dot-com era's mania and today's surge in AI, large language models, and frontier tech. The arguments go like this: narrative-driven investment. In 1999, the internet will change everything. Today, AI will transform every business in life. These stories attract capital, valuations outpacing fundamentals. Many AI-related startups or infrastructure plays command eye-watering valuations before they generate stable profits or scalable business models. Concentration risk. Just as a few internet stocks dominated the late 1990s, Today, a small number of Magnificent Seven or AI champion stocks drive a disproportionate share of gains, narrative overshoot, and weakening margins. When execution falls short, narrative cracks. Valuation, multiples compress. Cycle of easy money, loose monetary policy, low interest rates, and abundant liquidity are again cited as supporting factors in speculative tech investments. Analysts warn of echoing dynamics. One telling data point, as of September 2025, the Shiller P/E ratio, a cyclically adjusted valuation metric, has soared above 40, its highest level since the dot-com peak. That suggests U.S. equities are at valuation extremes. Moreover, researchers like those at research affiliates draw explicit parallels between today's AI narrative and the dot-com bubble. They warn that narrative-driven markets can produce extreme asymmetrical risk, big upside if things go well, catastrophic downside if they don't. In short, narrative, liquidity, crowd psychology, and capital cycles, the same forces that drove the dot-com mania, are alive today, often in more potent form. Of course, the world is not identical. There are key differences. More discerning investors. After past bubbles, institutional and retail investors have become more sophisticated or more skeptical. Better infrastructure and business models. Many AI projects build on real, scalable infrastructure and revenue streams, unlike speculative dot-coms that hadn't proven their value. Regulatory oversight and transparency. Today's markets have more disclosure and regulatory guardrails, though not perfect. Larger scale of tech firms. The tech giants today are far bigger and more entrenched. They tend to endure in part by diverse businesses and revenue streams. Decentralization and globalization. Many startups now arise globally, not just in U.S. tech hubs, diffusing some risk geographically, yet these differences are not guarantees. The same structural vulnerabilities remain, particularly when narrative and capital outrun fundamentals. Narrative and hype can overpower fundamentals, but only temporarily. The more compelling the story, the internet will change all business, AI will automate everything. The more dangerously detached valuations may become from business reality. Bubbles contain their own seeds of destruction. Excessive capital flows, blind optimism, compressed incentives, unsustainable burn, all these create instability. Once liquidity slows, the unraveling tends to happen fast. A crash doesn't mean death for the idea, but survival requires discipline. The dot-com collapse didn't kill the internet. It cleared weak players, encouraged stronger models, and laid the groundwork for lasting innovation, Amazon, Google, etc. But only firms that built solid fundamentals survived. We may be viewing this moment through a comforting lens. This time it's different. But let me leave you with this thought. Bubbles don't end when they lose steam. They end when capital flees. And that flight is rarely graceful. If the AI narrative starts losing plausible paths to profit, if investor patience thins, or if macro shocks emerge, we may face corrective stress even in sectors that feel bulletproof. The rise of narrative-driven markets means the loudest stories don't always survive scrutiny. Will this era end in a crash? Or will the strongest adaptations thrive and absorb the shock? Time will tell. If you found this story fascinating and frightening, do this. Like and subscribe so you don't miss our future deep dives into bubbles, markets, and modern tech. In the comments below, which current tech or story do you worry is the next bubble? AI Web3? Quantum computing? And if you want, I can build a companion video. Is AI the next dot-com bubble? Warning signs to watch. Want me to make that? Until then, stay curious, stay skeptical, and watch the narratives as carefully as the numbers.